What's going on, guys? Welcome back to another video. So in this one, we're going to be going over all of the crazy pieces of information that came out today that are critical for market movements going over the next couple of weeks. Now, what we really have to think about is that concept that I've been talking about a lot over the last couple of weeks, and on these moves up, we need to be thinking about, has anything fundamentally changed about the situation that we are currently dealing with in the United States economy and honestly the global economy too? The answer has been a resounding no. So these rallies that we've seen, they're most likely going to be short-lived, but we have a lot of things to talk about here. So before we get into all of that information, guys, if you do enjoy the information and analysis that I provide for you guys in this video here, make sure you guys go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And again, there's a lot of money to be made in the markets here, up, down, sideways, left, right. 1348 gang, make sure you guys comment down below too what your favorite trade of the day was today. You guys saw the trades that I was making, absolutely killed it again. But let's get right into it here. So coming over to the charts, let's look at the overall S&P here. So when we're looking at this on the daily time frame, we see a couple of important things. We do have a little bit of a supply zone up here, and every single time we've come up and tested this zone over the last couple of months here, we saw here a key level before I jump up. We bounced off of this level a few times, and then we come into here. It's now being used as a little bit of a supply zone here. We rally back up into here. We end up selling off. We rally back up into this level here, this zone today, we end up selling off again. Now, what this tells us is that, well, one, we're not seeing any follow through from the buyers to the upside. Now, why would we? The whole situation that we're dealing with right now is honestly terrible. We have high inflation. We still are witnessing high employment rates, which end up needing to come down in order for us to get those inflationary pressures out. We have nonsense over in the UK, the Bank of Japan. We have this Russian-Ukraine conflict, high oil prices. A lot of things are not looking good right now, but we're also seeing these sellers not following through either. A lot of these dips, these short-term big volatile moves to the downside, are getting bought up pretty aggressively. So what the market's bracing for is that next key piece of news. Now, what might that be? Earnings season is going to be critically important to where we're going in the future. And the one thing that I really want you guys to be focusing in on if you're going to be listening to any of these earnings calls or reading these reports is margin. Now, a lot of the costs of production have started to increase over the last year or so. Now, if the costs are being then passed down to the consumers, now that can still put these companies in a decent spot. But if revenues aren't growing and margins are shrinking, profits are coming down. So definitely something to keep a lookout for here. Now, again, the dollar, very, very important here. We are seeing the dollar relatively flat today, but what I really want to key you guys in on here is the 10-year treasury yield. Absolutely skyrocketing on this weekly time frame. We have not been at these levels since back in, let's see, 2008 July. When you have the 10-year treasury yield going up like this, we talked about this in yesterday's video, it's not a good sign for the overall markets here. So again, the other yields that we need to take a look at here are the gilts. We know that the Bank of England is going to be starting their bond selling program starting in November. Now, remember, we were seeing these price movements come to the upside, or not price movements, yield movements actually going up to the upside here. The yields were increasing. A lot of people were selling these bonds. Then the Bank of England stepped in and started to buy them. Now, if the Bank of England is going to be selling, and a lot of other market participants are going to be selling too, if we get back up to these levels again with these 30-year gilt yields, there's not really going to be anything stopping them from exploding higher. That's going to bring the pound down lower, potentially pushing the dollar even higher, and then our U.S. equity markets could fall along with that. Now, again, guys, with all of the money there is to be made in the markets here, as you guys can see, on the 5-minute time frame here, this cross down absolutely filthy. I walked you guys through this on the live stream that we were on today. If you guys do want access to all of these proprietary algorithms that we have that trade by themselves and alert you guys to everything that they are doing, they're wildly successful, back tested over years of data. Make sure you guys check out that link down below. All the live streams, the alerts are there. It's the best place to come and learn how to trade. If you do want to take full advantage of what the market is offering here, make sure you guys check that out. But moving a little bit further here, we need to talk about what is going on with the real estate market, the Bank of England and what's going on in England right now, and then the Bank of Japan. So looking at this statistic right here, so the US 30-year fixed mortgage rate rises to 7.22%, the highest since 2002. Now, what does this actually do to the housing market? Well, US's existing home sales crashed to 8-year lows. Why would this happen? Well, if the rates for mortgages are higher, you can no longer qualify for the same amount of a loan that you could have previously. So it lowers the demand aspect in the real estate market. So you're not going to see as many transactions taking place. And if you do, you're most likely going to be seeing transactions take place at lower prices. The real estate market is far from coming down. It has not bottomed yet. We still need to see real estate prices come down. The other thing that kind of puts the Fed in a little bit of a catch-22 or a paradox here is that what happens to all those people who need housing that are going to forego the opportunity to buy a home now? Well, they still need housing, so then they go back into the rental market. We just saw in the last CPI print that a lot of the increase in inflation data was due to rents increasing. Now, if rates still go up, which they are going to, the Fed is going to be continuously raising interest rates. At the current time, we have about a 99% chance here, 99.9. Let's see if this has changed. Now it's back down 97.9% probability of a 75 basis point rate hike. Well, then mortgage rates are going to continue to go up. It's going to be increasingly more expensive to get your hands on those loans. So then people just go into the rental market even more than they were before, providing more demand, increasing rent prices, and further coming back into CPI. So the Fed is in a very interesting situation here with what is going on with housing. We're going to see housing prices come down. It's just a matter of how much. Housing is a typically slower market just because it takes a longer time for these transactions to take place. In the equity market, if I wanted to sell stocks right now, I go to my broker, I click the sell button, and I'm done. But it takes longer for these transactions to take place and then feed back into the data in the real estate market. Now, going over and talking briefly about what happened today in the UK, we've been talking about this situation with Liz Truss a lot, but she has now resigned. We did talk about this a lot. She could be, again, right here, she quit early afternoon Thursday, midway through her 45th day in the role after initially being appointed on September 6th. It puts her on course to become the shortest serving prime minister in British history. This can be taken a bit bullishly by the markets because they really didn't have any faith in her ability to create policy and get things moving in the right direction. Remember, she flip-flopped. She was causing almost all of the pension funds to collapse with her tax cut program, and then quickly reversed it back, was going to increase corporate taxes, and then the Bank of England had to come in and start buying bonds to basically bail everybody out. So this situation here this morning was taken a bit positively by the overall markets, but it really just creates more uncertainty with what's going to happen in the future. So you had that initial pop and then that continued sell-off later. Now, this Bank of Japan situation is something that I want you guys to start focusing in on, and something that I told you guys that we were going to start focusing on after the situation with the UK started to get resolved or really came to a head. We pretty much know what's going to happen with the UK now. They've stopped their bond purchases. They've bailed out, the Treasury has bailed out the Bank of England, and we know they're going to start selling those bonds in November. They have to replace the Prime Minister, and that could be where some of that uncertainty comes from, and that can always carry over into the U.S. markets as well. But the Bank of Japan said on Thursday it would conduct emergency bond buying operations to contain rising yields. Where have we heard this before? Well, the Bank of England a couple of weeks ago. Now, when we come over and take a look at this article, the Bank of Japan on Thursday conducted emergency bond buying operations, extending its efforts to put a floor under bond prices as the yen nears a 32-year low against the dollar. This is not a good situation. The Bank of Japan is going to have a meeting next week where they're basically going to be talking about their yield curve conversion or yield curve control policies. Now, if they end up pivoting and start raising rates and trying to get away from these really, really low or zero rate environments, that is not going to be good for the overall markets here. So again, we have to key in on about what's going to be happening with the Bank of Japan here. And thinking about this situation, they're going to be enacting these short-term bond buying programs, but very similarly to the Bank of England, it is very, very, very possible that they then come out and say, we're going to stop buying these bonds, and these yields can go even higher. The pound can the yen can depreciate even more, and then we see some more nonsense in the global currency markets carrying over into the U.S. equity markets as well. So guys, at the end of the day, when we think about price movements in the overall market, it's not over. We still have a long way to go. Protect yourselves the best way you can. Make your money. Get out. and go do something fun. So guys, that's going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening. See you guys in the next one. Peace.